Mortgage rates are finally coming down, so owning a home is going to get so much cheaper, right? No, it's not. But I thought that lower mortgage rates should make homes more affordable. Well, not exactly, because here's the truth that most people don't want to hear. Even if mortgage rates drop, owning a home is still getting more expensive. And today I'm going to walk you through exactly why. So whether you're buying your first place, moving up, or just keeping an eye on the market, this is the info you need to hear before you make your next move. Imagine this. You lock in a nice 6.3% mortgage rate today. You do the math, you expect that will make owning a house much cheaper. Then a few months later, you look at your bank statement, your insurance bill, your property tax, your energy bill, and you realize you're still paying way more than you thought. So what gives? Well, let's start with the basics. How do mortgage rates actually affect the cost of buying a home? Well, it's simple math. The higher your mortgage interest rate, the higher your monthly payment, and the more you'll pay over the life of the loan. Let me show you what I mean with a quick example. Let's say you are buying a $400,000 home with 10% down. That is a $360,000 mortgage. At a 7% rate, your monthly principal and interest payment is about $2,395. At a 6% rate, that drops to around $2,158. And at a 5% rate, that is $1,933. So yes, a lower rate can save you hundreds each month and tens of thousands of dollars over the life of the loan. But here is where it gets tricky. Before we move on, if you are getting value from this video, do me a quick favor, hit that like button, subscribe to the channel, and tap that notification bell so you don't miss any future videos like this one. I try to post new and helpful content that helps you make smarter real estate decisions regularly. So how are interest rates determined? Mortgage rates are influenced by a bunch of factors, including inflation. Higher inflation means that lenders will demand higher rates. Federal Reserve policy. The Fed's benchmark rate doesn't directly set mortgage rates, but it does influence bond yield and overall cost of capital. The bond market and treasury yields, especially the 10-year treasury. When yields rise, lenders raise mortgage rates. Your credit risk. Your credit score, your down payment size, the loan type you are using, conforming versus jumbo versus FHA, and your loan term, 30 years versus 15 years, all matter when it comes to your mortgage interest rate. Now you can also technically buy down your interest rate by paying what's called discount points at closing. 1 point equals 1% of your loan amount and generally shaves about 0.25% off of your interest rate. So on a $360,000 loan, 1 point would equal $3,600. And that might drop your rate from 7% to 6.75% and save you maybe $50 to $60 a month. Sometimes it's worth it, sometimes it's not. It depends on how long you plan to stay in the home. You have to do the math. But here's the part no one talks about. Why lower mortgage rates might backfire on buyers. Lower rates equal lower monthly payments, right? Yes, but that also means more buyers flooding the market. When rates drop, affordability improves for a lot of people. And guess what happens next? Competition goes up. Bidding wars heat up, sellers get bold again, and prices, they rise. Remember early 2021 and mid 2022? Rates were in the 2s and 3s. Prices skyrocketed and every home had like 20 offers on it. Fannie Mae even said in August of 2025 that a rate drop to 6% could trigger a resurgence in buyer activity and renewed upward pressure on prices. Even if rates come down, the cost of construction and materials, lot prices, and labor shortages, these things tend to keep home prices elevated. So the benefit of lower rates might get eaten up by price increases, especially in popular areas or low inventory markets. So ironically, waiting for rates to drop might just push prices higher, especially in tight markets. So be careful what you wish for. Now let's look at the hidden costs keeping monthly payments high. Let's say that rates do drop significantly and you lock in a great one. Awesome. But that's only one piece of your total monthly cost. Here's where the real pain shows up. Even with a lower rate, you still have all of the other costs. And these are all getting worse lately. Number one, homeowners insurance. According to Policy Genius, the average cost of homeowners insurance rose over 20% between 2021 and 2024, and it's continuing to climb today, especially in weather-prone areas. Even in Ohio, we are seeing carriers pulling back or raising premiums due to increased repair costs in severe weather. Expect to pay at least $1,500 to $2,500 per year, depending on the location, the age of home, and the coverage. Number 2, property taxes. While national data on tax rates can vary, the fact is that property values have been rising. So even if your rate stays the same, your tax bill goes up. Also, many local governments reassess home values every few years. High appreciation leads to larger tax base and higher bills. Home values are higher now than they were 5 years ago, so you can only guess what taxes are doing. That monthly escrow payment, it's growing. Number 3, utilities and maintenance. Electric bills, gas, water, garbage removal. It's all more expensive than it was a couple of years ago. According to the U.S. Energy Information Administration, electricity prices rose over 11% in 2022 and have continued climbing every year. Utility prices can at least be somewhat predictable and stable. One of the real hidden costs of homeownership that catches people off guard is the maintenance. And I'm not just talking regular routine things, but things like roof leaks, HVAC problems, plumbing leaks. These are unpredictable. Your furnace could go out in the middle of winter. Your appliances could bite the dust anytime. The truth is, your mortgage payment might shrink, but the rest of your costs are still on the rise. Number 4. And let's be real, everything else is getting more expensive. Groceries, gas, childcare, you name it. These are all rising. Inflation isn't just affecting housing costs. So even if your mortgage payment drops a little bit, if everything else is up 5 to 10%, your disposable income shrinks. So that lower rate might save you a couple $100 a month, but that might just get swallowed up by everything else getting more expensive. Even if your mortgage rate drops from 6.3% to, say, 5.5%, saving maybe $150 a month, you could lose more due to higher insurance, taxes, utilities, or because home prices rose. So what does this all mean if you are thinking about buying a home? Yes, lower rates can help, but don't assume that they'll make buying significantly easier or cheaper. Prices could rise, insurance and taxes are likely to stay high, and your total monthly costs might not drop as much as you think it would with those lower interest rates. So instead of trying to time the market, focus on being financially ready. Here's what that actually means in real terms. Know your budget inside and out. Too many buyers start with the question, what can I get approved for? When the real question should be, what can I comfortably afford each month? Pre-approval tells you the maximum the bank might lend you. It doesn't consider the vacations you want to take, the daycare bills coming in, or that dream kitchen remodel down the road. A smart buyer builds a budget that includes a realistic monthly housing cost they're comfortable with, not just what the lender allows. You need to factor in savings goals, retirement contributions, and lifestyle expenses alongside the mortgage. The bottom line, the bank's number is not your budget. Your life is your budget. Next, run real numbers, not just the mortgage payment. It's easy to fall into the trap of only looking at the principal and interest, but the full monthly cost of owning a home includes property taxes, and these can rise over time, especially if your area reassesses values every few years. Homeowners insurance premiums have jumped almost 10% nationally in the last year alone, according to Maddox's 2025 report. Think about utilities. Heating, cooling, water, electricity, energy costs have climbed steadily since 2022. Think about HOA fees or maintenance fees if applicable. Before you start shopping, plug everything into a full monthly cost calculator. Many buyers skip this step and regret it when the escrow account or the tax bill hits. Next, have a solid down payment and emergency fund. The more you put down, the less you borrow, and the smaller your monthly payment will be. It also might mean avoiding private mortgage insurance if you hit 20%, or at least keeping PMI costs lower if you put 10 to 15% down instead of the bare minimum. But here's the kicker. You need more than just the down payment. Roof leaks, furnace breakdowns, unexpected job changes, they happen. A good rule of thumb is 3 to 6 months of living expenses in a separate emergency fund. You should also plan for 1 to 2% of the home's value per year set aside for maintenance. If you stretch to the absolute limit on your down payment with nothing left over, one bad month can wreck your finances. Lastly, don't stretch yourself just because the bank says you can. If the lender says you can buy a $500,000 house, that doesn't mean you should. Maxing out your approval can leave you house poor. Great house, but zero budget left over for living your life. That's how vacations disappear, retirement accounts stay empty, and credit card bills start creeping up. A better approach? Aim for a home price that keeps your total monthly housing costs at or below 30% of your gross monthly income. Factor in rising costs, taxes, insurance, utilities, because these will go up over time, even if your mortgage payment doesn't. That gives you breathing room for savings, repairs, and actually enjoying the home you worked so hard to buy. Here's the bottom line. Even when mortgage rates ease, the cost of homeownership is creeping up from every direction. The interest savings can help, but in many cases, they won't fully offset rising costs of insurance, taxes, utilities, maintenance, and inflation everywhere else. If you are thinking about buying right now, or in the next couple of years, don't just watch the interest rate headline. Look at your full cost of owning. Owning a home is still worth it for most people, but you've got to be prepared with your eyes open and your calculator ready. If you found this video helpful, do me a favor, hit that thumbs up and consider subscribing for more real estate tips and advice. If you're looking for ways to avoid homebuyer's remorse, check out this video right here. And if you are thinking about buying in the Cleveland area or just want someone to help break down your numbers, reach out anytime. I'd be happy to talk. If you're not local, I also have a great network of agents across the country, so reach out and I can find someone in your area to hook you up with. Thanks for watching. I'm George Poporad, and I'll see you in the next video.